probability trading strategy, you're full of crap.
If things aren't working, then that's a quick trip to the poorhouse.
To learn how to drive the beater before you can drive the Lamborghini.
Now you're playing with the house's money.
Wow, what a rocking entry. I always love that entry. Anyway, hey, what have I told you? That most traders don't fail because of bad strategies, but because they fall into traps they don't even see coming. It happens all the time. Someone starts trading, hits a few wins, confidence skyrockets, and then boom, account blown up. Well, today we're going to expose 4 biggest mistakes and myths that destroy traders, and more importantly, how you can avoid those myths, if you will. And trust me, mistake number 3 is one that will absolutely, even experienced traders struggle with. So, hey, welcome back to the Trading Truths. I'm Dennis Wilborn, and my co-host Mike Lamothe. Say hi, Mike.
Hi, Mike.
Yeah, so hey, man, Mike did a great job on IBD Live on Friday. If you haven't seen it, go over there and check it out on IBD 5. But most importantly, Mike, the quality of we've had great guests on today.
Oh, we sure have.
This whole week. Last week had a great guest. Who was our guest last week?
Oh man, last week we had. This is.
Oh, geez, come on, Mike. It was just last week. Well, he was great. He was absolutely awesome. Heading up a Christian.
Yes, thank you.
Yeah, and so Christian was our guest. He's basically competing on the U.S. U.S. investing. But today, I think this is top shelf. Top shelf. Our guest for this week is Kathy Donnelly, co-author of Lifecycle Trade. Kathy is a full-time trader with, well, I guess, I don't know if you call it full-time. She trades for a living, is what I'll say. Experienced studying IPOs, super growth stocks, and she's here to help us break through the biggest myths in trading so you don't have to make the same costly mistake. So now a little known fact about Kathy, and I got to share this because I looked it up. I asked Grok over on X, and so a lot of So anyway, not only is she an expert trader, but she's also an Ironman athlete. So the question, Kathy, is, does the level of discipline and endurance carry over to your trading from what you find in your training for the Ironman?
Yes, absolutely. To train for an Ironman, you need to have a plan and a schedule of when you're going to execute your plan, when you're going to swim, when you're going to bike, when you're going to run, when you're going to eat, before the workout and after the workout so that you can recover. And also with trading, you need a plan, right? You need to know what stocks you want to buy, what patterns you're going to buy, and are those stocks near those patterns? And then what time of day, what time in your day do you have time to trade? Are you working full time, so you have to do maybe stop buys or stop sells, to get you out, or are you trading in the morning and a day? Are you a weekly trader? In some ways, I'm a weekly trader because I train for Ironmans, and even if I'm not training for a specific Ironman, I'm biking, I'm swimming, I'm running. So I really like to look at the weekly time frame and make a lot of decisions on Friday, and all of that needs to be in a plan, just like your Ironman plan. So yeah, absolutely, great question.
Yeah, no, and what's very interesting is, of course, I'm the OG here. Okay, I'm the old guy, but I like to run and I work out. I even, I'm in my 70s. I always actually go out and do sprints and I run hills and all that kind of stuff, and it's absolutely amazing. But the thing that Mike is also a distance runner, has run a couple of marathons or a few marathons, and so I find what's really interesting is sometimes with trading is, I think that discipline we developed being an athlete, especially an athlete in individual events, it does translate over into. So Anyway, well, Mike, let's ask Kathy. Kathy, just tell everybody about yourself, please.
Okay, well, I'm Kathy Donnelly. I'm happy to be here. Thank you so much for having me on your podcast. I have been interested in investing all my life. My parents were value investors, and they imparted on me the wisdom of, building a retirement so that I could retire and not have to worry about, worry about them helping me. Having to fall back on my parents, but then also so I wouldn't have to, rely on my 401k or Social Security. We know the situation with that. So when I started doing the math, I was like, okay, well, value living off dividends, like I thought it was going to take too long, and I want to get there faster. So then I was like, I want to retire at 30, or I want to retire at 40. And so that's what really got me on my path to find a system that would get me there in a short amount of time. And it took a few years and then reading a few different books. And then eventually I came across William O'Neill's book, How to Make Money in Stocks. And then that was the system that really clicked with me. Being an engineer like yourself, Dennis, I like the factuals of it, charting and, seeing where there was above average volume and there was a below average volume and what were the prices doing and so on and so forth. So that really stuck with me. And luckily, through that system, I was able to retire early. And actually, I guess I didn't officially retire. My company closed down their local office. I live in Denver, Colorado area. And so there actually was a gift. They closed down the office. They wanted us to relocate. We weren't going to relocate. And then at that point, I had amassed enough where I said, okay, I don't need to work corporate anymore. I can trade my own money. Thank goodness. And here I am today. And then I met my co-authors in Illinois. We went to a local IBD meetup, and eventually we came up with this idea to research IPOs, wrote the book, and now here I am talking about with you guys IPOs and super growth stocks. So that's the short version, I think, with the main points highlighted.
Yeah, no, and because your partners in crime there is it Eve Bobak?
Yes, Eve Bobak. She was the initiator of the whole thing. She wanted to do a study on IPOs, and she asked me if I would be interested, and I was like, yeah, definitely. And then we decided to ask Eric Kroll, and he said, yeah, I'm on board. And then Kurt Dale is also very good friends with all of us, and we asked him to be a part of it, and that's kind of how it went down. And it took us about 4 years because we kind of dragged our feet. You know how it is, a project. And, okay. Yeah. And then finally we gave ourselves a deadline and we got it done. And then when we were done with the research, we actually didn't plan to write a book. And then Eve had always wanted to write a book. So then Eve was like, well, does anyone want to write a book with me? I think we have enough here for a book. And we just finished the research, and finally I was like, okay, I'll write the book with you. So even I wrote the majority of it. Eric helped out. And of course, Kurt contributed as well as part of all the research in addition to that. So that's how that came to be.
Oh, that's awesome. And we're going to be sharing your book and how people can get it over on Amazon a little bit later. And it's a top seller on Amazon, guys, with, it's almost 5-star rating. It's fantastic. A great book. So Mike, what do we want to jump in and what were we going to talk to Kathy about? I forgot.
Yeah. So Kathy, well, one of the myths that you had mentioned that you hear quite often is that trading is easy, right? So a lot of people think that trading is just clicking a couple of buttons and watching the money roll in. I was one of those people that thought that that's what trading was way back when. So if it really were that easy, why do so many traders blow up their accounts in their first year? And let's start there. Well, why do so many people believe that trading is easy, and what happens when they underestimate it?
Yeah, that's a great question, Mike. And I think what the issue is that people, from my perspective, investing is like a 4-year degree. And I actually coined that from my friend Eric Kroll, one of the co-authors of our book. He actually did a presentation way back when I was just an IBD meetup member with him, and he was the one running the meetup. And he did this whole CanSlim University, if you will. And it was,
Right.
What happens at freshman year and what happens at sophomore year. And so I've really held on to that concept. And that's really, I think, and how I would say how long it took me to really start to be consistently successful. And so what happens, and you're alluding to it, is maybe we're having a strong market. They make a few buys, they make a lot of money right away, and then they think they got this. And then immediately the market turns, all of a sudden they're losing money and they're like, oh my gosh, what's happening? And they don't really realize that investing takes about the same amount of time as a 4-year degree. And so I think that's really, and when I talk to people and they get their hopes up, I try to remember, this is only your freshman year. Because I do, as I mentioned to you guys, I do a little bit of investing coaching on the side. And that's one of the common things I like to remind people, like, this is just your freshman year, and then let's make this progress, and then we'll move on. And then you'll slowly be able to build, because you can't absorb it all at once, right? Things take time to sink in. So those are my thoughts on that.
That's an excellent analogy. I love it.
So, okay, 4-year degree. Now, Mike and I have our own time frame on how quickly it took us for trading to become easy for us by following our rules, our plans, our systems that we designed and all that kind of stuff, which is made up of some of the IBD principles and that kind of stuff. How long did it take you from when you said you were interested? You sound like you had a really great, growing up, because your mom and dad were investors, at least, so you knew about that. How long did it take you from the time you decided, okay, I'm going to become a trader, to the point where you gain the confidence and ability to be consistently profitable, to then, because then that offers you the freedom to then step out on your own? So how many months did it take you?
Well, that's a great question. I mean, if you start from when I was in college, that was when I opened my first brokerage account. For the people that remember oldie discount brokers, like, that's where I opened my first account. And, the first few stocks I bought, I lost money. And then, I went, as I kind of alluded to, I went through different systems, and I continued to lose money. I mean, I didn't blow up my account, because I was just trying things here and there, trying to find a system that worked for me. So, I mean, if you want to count from college, I mean, it was a long time, at least 4, 8, 10 years. But then once I found the Can Slim system, which was about, I think 2005. And then I went to my first level 4 in like 2006, 2007, and then 2009 was that great bull market that lasted. I always like to say it was, from 2009, 2011. That's when I really started making the big money. So if you start, I think the best time to start would be when I first clicked with Can Slim, and I was like, okay, this is working. I'm finally making money. I wasn't making money like so much where I was in that false belief that, oh, okay, I've got this. I knew I still had a lot more training to do, especially seeing, looking up to, Eric and the other people that were leading the meetup. I could see there was going to take still a lot of work. So anyway, so I would say from 2006 to 2009, that was a good 3 years. And then 2009, we had a great bull market, which supported the system very well. So that was like another, 2-3 years. So I mean, I would say, yeah, a good 4 to 6 years where I started really feeling confident, and I was starting to make 100% gains. And then at that point, it was just accumulating enough such that when the time came, which was when my office closed in Denver, I was like, okay, I'm done,
Yeah.
So.
Yeah. It's so fun to remember that I'm done day.
It really is.
And because my I'm done day came in, I want to say 2006, I think. It was wild. I mean, it's just all, and I have to admit, I wasn't totally ready for it.
Right.
So, and it kind of like shifted the aspect of, oh my gosh, now it's totally on me, because I'm not drawing a regular paycheck,
Right.
Every 2 weeks. So
it does take getting used to, for sure. And actually, speaking of the Ironman, that's that I retired from corporate and then went straight into Ironman training. So that was my new full-time job. So for me, the transition actually wasn't too dramatic, because all my time went to training for the Ironman.
Excellent. Okay. So while you had a what could have been a void, because so many people, when they retire, they have a void in their life. But
Mhm.
you had something to immediately fill that void up, training for Ironman. And I imagine, help us understand, I imagine that training for Ironman actually took away time where you'd be thinking or working on your trading, and kind of in a good way, because you didn't get overly focused just on the trading.
Right. Well, the real good news, I think, for me is because I was learning trading while also working in corporate America. I always told myself I had two jobs, and it was the 40-hour
Mm.
week job. And then after, the end of the day, then it was the trading job, going over the stocks and the screens and keeping up with that on a daily basis. And then, trying to look at it during the day. So when I switched to the Ironman training after working corporate, well, since that took the place of it, I really didn't start looking at the market anymore, because at that point, my system has been ingrained. So
Right.
I do spend more time now looking at ideas and things because I enjoy it, but not because I have to. And so the more time I spend is more on research, not necessarily on the execution of my plan. I mean, of course, always tweaking rules and trying to improve how can I do things better, because, we're human. And I think that's the other thing people forget, is that we're human. We're not going to be perfect. We're still going to make mistakes, even if we do know the rules, because your emotions, you get caught up in the moment. But the more we can harness those in and know what we're thinking that's causing that, then we can tweak them to reduce that outcome.
Yeah, right on. So, and Mike, I see your cursor there, buddy. Go ahead with that.
Oh
Can you,
yeah, so in the lifecycle trade, you emphasize a systematic approach. How does that help traders avoid the trap of thinking that trading is easy?
Well, I mean, a systematic approach can be detailed or simple, but I think an approach is, of course, necessary. So, um, I feel like, and it just depends on your style, like how detail oriented are you and how much detail do you want to go into. But
Mhm.
either way, there is work required. And so what does easy really mean, right?
Mhm.
To me, easy is like, I'm not exerting any effort. So there's always, I feel like there's going to be some effort that has to be done. And to me, any work that has to be done is not easy, even if you keep it simple with maybe a few like indicators that you look at, or multiple indicators that you look at. So I'll just give an example with the market. One of the things me and my co-authors like to do is we just look at the 10-day moving average on the NASDAQ and S&P, the 21 exponential. Are they trending up or are they trending down? And then where's the close in relation to the 21 EMA, to just help us
Mhm.
simply, what is the trend of the market? But some people might be looking at all these other bands and these stochastics, and there's like so many different things you can look at.
Mhm.
Both, I think both are a systematic approach, and one is easier than the other, but both requires work. And so it just depends on what you're designed for and what gets you excited to keep you going.
Interesting.
So, Kathy, do you think that, like your co-authors, Eve and Eric, are they also technically inclined like you? You're an engineer and all that kind of stuff. They also have that kind of background also?
Well, Eric and I actually are both engineers. We're electrical engineers also.
Yeah.
And we actually both worked for the same company for a while, not at the same time. So it's
Yeah.
kind of funny. I have this natural connection to Eric because of all of that. But Eve was a business and a finance major.
Okay.
So she did not have the engineering background. And then Kurt was in the Navy, Top Gun pilot, uh, flying fighter jets, and then became a pilot for United Airlines after that.
Yeah.
So
He and I need to talk, because
yeah,
I was a naval aviator also. I
yeah,
don't know.
that would be a great conversation, I bet.
We
His picture's actually in one of those fighter books. I mean, I forget what the name of the book is, and it's a total Top Gun shot, but it's Kurt.
yeah,
And
cool.
the other guy, and it's like, wait, is that from the movie?
And that's Kurt.
Kurt Dale, yeah.
Okay. And well, one of the the reason I asked that question is, I know when I started developing my system and my strategies, I purposely broke it down because I wanted a clear and simple approach to help people make, good, sound, trading decisions, but also let them consistently trade well. And in doing so, I find as I would talk to many of my engineering, friends and all that kind of stuff who wanted to start trading, they were always about complexity, about let's make it harder. I'll engineer this automated system that'll work, and then you don't have to worry about it. Everything, you put everything on autopilot, if you will. And that's not AutoPilot Trading, folks. That's me. No, but the question I want to ask is, like you said, there's these strategies. At what point do you think a strategy becomes too complex? Because I'm sensing that the strategy that you're using, you've spent some time trying to simplify it to make it as easy as possible so it doesn't interfere with the things in life that you really want to do.
Right, exactly. And I think, again, because I was working, I had to keep it simple. So Bill O'Neill, who wrote the book, I feel like, I thought what he was teaching was fairly simple.
Yeah.
It is complicated. Yes, because you have to make sure you understand what's happening bar by bar. So that's the detail and the complication is really understanding, if there's a cup with handle base, is there accumulation or distribution in that cup with handle base? And you have to look at it bar by bar. Where is the closing at the end of the day? What's the volume? That's the detail and the complication. But to consider, there's so many other factors you can consider that you can make it too complicated. And then that prohibits you from then making the buy when the cup with handle happens. Like someone asked me the other day, we were having a conversation. I'm like, okay, Duolingo's breaking out. I'm going to add here. And the question she asked me, and this was one of the people that I was coaching, she's like, you're going to buy it even with the market like this? And I'm like, yeah. Because, the stocks aren't going to wait. And, the market, if you let the market and all the news going on in the world that could prohibit you from actually taking action. And then you're going to miss all the great stocks. And then when it finally turns good, you're buying them too late. Right.
That's
and
right.
that's the counterintuitiveness of the system that William O'Neill, at least, was saying it's going to feel really bad at the bottom, but that's when the fall through day happens and you need to buy. So there's definitely the complexity is there. But I definitely don't think you need to be a finance major and actually, if you think about it, those the people that go and become, registered financial advisors,
Sure.
They have to take those tests, the Series 7 and whatever they all are. And I don't know if you guys have taken them. I haven't taken it.
No.
There's no way I would pass that thing. And it's so not what we do.
Yeah.
So you have to be inclined to be able to read charts. But I think if you, depending on, if people are more creative or they're not creative, whatever the brain, but it can be done. But the time has to be put in and you have to put in the work. And so I think people think, well, if I'm not smart enough, and then I don't think that's true. I think anyone is smart enough and everyone is worthy and they're capable. They just have to be willing to do the work, and doing the work can make you feel uncomfortable and make you feel like, I don't know if I can do this, but then that's where you persevere and you keep going. And I remember I had to take time. And when I was reading the book, I'm like, line by line, I'm like, I gotta make sure I know what he's saying here. And I remember thinking, okay, I gotta literally take the time to make sure I understand what's happening bar by bar. And then over time it becomes easier, right? Because the more you practice, the more it sinks in.
The more you practice, what do you do to practice?
I look at stocks all the time, stock charts. And in fact, I don't know, I'm sure you guys follow Mike Webster on X. One thing he posted not too long ago was every time you look at a chart, you should look for something to learn. And that's what I do, even if it's not a stock I own. I like to look at charts on my iPad a lot because it's just convenient. I can be on my couch and I'm going through, 50 stocks, 100 stocks.
Right.
And it shows me a good period of time. So sometimes I'll just look at it, take some time, like, oh, I missed this one. Let me see what it looked like when it started, and what did it look like in the middle. And then I'm just always picking up new things. And sometimes I'll screenshot it, and then I'll make a note why I'm screenshotting it, so that I can search back on that, like a tiny week or big volume, or whatever it is, and then I reference back to it.
So how does simulated trading? Do you do simulated trading? Trade simulations?
I don't. Remember when, I think it's still out there, that Market Smith Arcade or Market Surge Arcade?
Yeah.
Oh yeah, wow.
Remember that?
Goes way back.
We all got into that for a while there, but no, I don't really do that. I don't know. I feel like for me, it just takes too long. I just like to look at it. I guess I do it, but I'm not, I don't do the bar where the next bar shows up, I just look at the whole thing, and then I'm just studying the whole thing. And that's actually, that was a big aha moment for me. Even ever since Bill O'Neill retired and he stopped doing the level 4s, we were looking for another avenue to continue our learning. And so we created these stock retreats, and basically it's just made up. But we go on a trip and we plan to focus on something. What do we need to work on, or what do we want to improve, or whatever. And we bring stocks and we talk about them and kind of come up with some ideas, do some journaling. And the very first stock retreat that we did, we lugged all our big level 4 chart books, and from like 5 years. I mean, it was crazy. It was almost like a suitcase full of chart books. I'm like, why are we carrying all these with us? But we did. And I remember just sitting in the hotel room. We had a beautiful room, which we got on accident, but that's a whole nother story. But anyway, and I was just looking at the charts, and I'm just staring at them. And then that's when things started to like come off the page to me, and then that it still happens to me now ever since that moment. And that's why I like to tell people, you want to train your eyes, and you just look at them, and then things just start popping up, and then things start clicking. But that all takes time, right? Because that was the last stock retreat. The first stock retreat we did was after Bill O'Neill retired, and that was already, I don't know, many years later. So that was like 10 plus years after I'd already been successful, and I'm still like picking up all these things. So it's really a lifetime journey, improving and there's so many things.
And so, Mike, did you see the note I left for you?
Yeah. So the next myth, myth number 2: trading is gambling. Trading is gambling. So how many times have you heard people say the stock market is just a big casino? And if that were true, why do so many traders win year after year while others end up losing everything?
Yeah, that's a great question. And that question was asked to me, like, well, why isn't that just gambling? And I was like, what? I couldn't even believe that they asked me that question. That's why I brought it up for today. When we're talking about what to talk about. And I really had to think about it. But what I want to say about it is almost to your question earlier about having a systematic approach, right? We know what to look for to put odds in our favor.
Right.
And so some of the things I like to tell people is like, okay, how many things can we find that are odds in our favor that show that this trade is going to put the probability of our success, on that high side. And so that's how I answer that question. Because if it was gambling, like you just putting money down, you don't know if you're going to get an ace and a king. And what could you do to put the odds in your favor? Nothing.
Yeah.
Unless you're cheating, and then, they're going to haul you away. There's cameras everywhere watching you. You don't know what those cards are going to be. But we know that we can look for accumulation. We know we can look for, the blue bars, the skyscrapers of blue, which is a term that Jim Ropel likes to say on the chart, skyscrapers of blue volume. We can look at the fundamentals. We can look at, the up-down ratios. We can see what quality institutions are buying the stock. And all those things put the odds in our favor for probability of success. And then if the market's also trending up, we've got that behind us. So from that standpoint, I don't see how you can call it gambling. Now, it may not work, but we've at least reduced a lot of the potential that it will not work. Mm-hmm. So yeah, great question.
And so Mike, that was a really good question. So, here's can I do just a real quick follow up on that? Is that so? I think almost that we should almost reverse the table when somebody says that trading is like gambling or just gambling, and ask them the question, or be able to answer the question: how is it not like gambling? How is it not like gambling? And Kathy, you just hit on almost everything makes it not like gambling because of we're working to put the probabilities on our side. And so part of the thing is understanding probabilities. And we've seen enough charts, like some of us, we've seen thousands and thousands and thousands of charts, worked through them, done thousands of trades. And we've seen the process work out so that it almost becomes second nature or a habit to recognize the patterns when they set up, and you go, aha, that's when I have to act. And so how do you size? That's another thing when you talk about with gambling. How do you size? Okay, you see your setup, and how many trigger setups and triggers do you have? Which patterns do you like to focus on? And that assures that you're not gambling.
Well, I like to focus on first stage basis. So when I'm looking at charts, I'm always looking for that first stage base. Because then I know if this is going to be a successful super growth stock, true market leader, model book stock, whatever you want to call it, it's going to start with the first stage base. And because I'm a long-term holder, I like to hold for the long term. I mean, that's my number one goal. I have to get that first stage base, because if I'm buying a fourth stage base, then unless I guess it's a stock that has been already a leader and it could continue to keep going, but that's going to increase your risk because you don't know. It might need to take a period of time to rest for many months at that stage before it continues versus completely collapsing. So I like to look for that first stage base. Most of the time it's a cup with handle, or it's a cup with handle base on base with a cup with handle, maybe a flat base next to it. I've seen a lot of those. If I miss that first stage base, I will buy the second stage base as well. But I love seeing base resets. I love seeing base resets where maybe it's only about a 20 or 30% range overall over multiple weeks, maybe a few months, but then it resets in that time frame. I love those. And then, I do the standard, the old, I guess it was the Bill O'Neill. I divide my portfolio by 8 and then, and then adjust my position sizes accordingly. I do have to adjust that though at times, because again, if I'm getting a lot of those first stage bases and then they're working and then they're accumulating, so then I have to adjust accordingly. And that's been a little tricky because I've had a lot of success with that lately.
Sure.
So I'm actually still tweaking that, but if we're just starting from scratch, like that's how I like to do it. And then, the market had been so bad for so long before, we had these stocks that were doing well. I was just buying really small 1% positions. So then I had to catch up. Always adjusting and tweaking that, but definitely want to make it enough so that it makes a difference, right? Because I don't want to have 20 stocks at all. I want to have like 10 or less. And and of course I do still have I have IRAs and that kind of thing, but those are slower movers, and I don't include those in the core growth account that I use.
So what is your definition of, because you said you want to get, you want to buy in first stage bases if possible. After you hit your first stage base, do you use simply breakout triggers, or are you also an IBD alternative entry point trader?
Yeah, that's a great question. I mean, I will look for downward trend lines on a daily chart of a cup with handle to try and get in before that handle, so I can start building that position and then finishing it when it actually crosses the traditional cup with handle buy point.
Sure.
Yeah, I would say I do that. And then, yeah, I'll definitely, if I have opportunities, because what I like to do in addition to the first stage base, and, and then I want to accumulate on the way. And if there's enough space between the first and second stage base, and when I say space, I mean like a 50% rise, not just a 20% rise. Because if you don't only have a 20% rise, then likely it's going to rebase, create a new base that's going to come back to that first stage base buy point, and then you're almost at break even, and then you're getting nervous, and then it goes again, kind of like a stair stepper. I think is the best example of one of those.
Yeah.
But like NVIDIA, when it had its first stage base, it went up at least 50% before it built its second stage base. So you had a lot of time where you could even add up along the way and then make another position size at the second stage base. So that's the ideal situation. Did I answer your question?
Yeah. No.
Yeah.
So, yeah, Mike, you have any other questions in there for
so you'll build into a position as it's running, and then it builds another base. You'll add to the if you were already in at a lower price, you'll add at that second stage base. But
absolutely.
what if you miss that initial move, and then you see the second stage base developing? Would you buy on that one, or would you pass and wait for a first stage base to develop on something else?
No, I will do, if I miss the first stage base and it builds a solid second stage base, and it looks like it's going to be a super growth stock just based on what has happened from the first to the second stage base, I absolutely will buy that second stage base. But what I don't like to do is buy the third or the fourth stage base. And even in a strong stock like NVIDIA, which also created a third stage base, I actually did buy that base, breakout, but then I sold that one right away. And then I trimmed all of those add-ons because, again, I mentioned to you that I like to trade long-term, and I want to be able to hold for the long term. Like in NVIDIA, I'm very fortunate that I've been able to have it for so long that I've achieved, the 10-bagger status on that one, my very first one. And so in order for me to do that, I have to trim all those ads, the third stage base, and I'm only keeping the core, which is at the first stage base core, and then the second stage base core. If there's enough, again, there's enough space, which right now there's been plenty. And then I like to use the mental capital preservation rule that we created and talked about in the Lifecycle Trade, which is I want to retain a certain percentage of gains. And I use 50%. And that seems to keep me in most stocks for the longer haul. And I know that for some people can be like a huge drawdown, but as long as I'm always retaining 50%, then I'm always stair-stepping my equity curve. And I use that in conjunction with the 40-week line, which is a long-term line, 40 weeks. And I find that using the 50% retention of gains number along with the 40-week line really allows me to hold for the long term. Now, NVIDIA did break all of that over, during this last I don't want to quote the years because I can't remember the years exactly, but that was a totally different strategy because that was the first time I was actually trying to hold something for a multi-year that I thought could keep going. You see all those tweets on X all the time where they say, oh, if you'd held this for this long, you'd be up a crazy percent, right? So I was laser focused on NVIDIA only for that. And to do that, I had to get rid of all the cores for that. So that's a super exception. So I just want to make that point that that's different. And that's not how I handle most stocks. Most stocks, my standard rule is the 40-week line with the 50% retention of gains. And then I'm out until it creates a new first stage base or it doesn't, and looking for the next one.
Now, you mentioned that you sometimes you trim the position on the way up, and for the longer term holding, the retention of gain at 50% or the 40-week moving average, which equates approximately to the 200-day moving average. Do you take any profits on the way up? Like at 20, 25%, take a little bit off the table, but leaving the majority of it in. But a certain percentage, you take some profit off the table earlier on.
Not until I get to the third stage base. Then at that point, I do trim, because that's when it starts to become more volatile. The stocks are starting to, not work as well. And then other people are probably taking gains, like myself. And so the only way for me to hold it during that time to see then if it's going to recontinue is to trim off all those gains. And so then that way I'm not worried about the intraday mumbo jumbo, right? Because I've got the second stage, I've got that space in between. So yeah, that's the only time I do that.
Excellent. And so what I want to do, guys, really quick is, before we jump to the next session, I just want to pop up a copy of, there is Kathy's book, The Lifecycle Trade. And I've dropped a link in the chat, and I will also put it in the description on YouTube, and Michael put it over there on Spotify, so that you can pick up a copy of her book, How to Win at Trading IPOs and Super Growth Stocks. Highly recommended. And I have read the summary, and I've read the highlights for the book, but I want to dig deeper into it, because I've had several people approach me of, how do you hold things for the long term? Some of the nonprofits that I work with. So excellent. So, have you ever heard you ever hear someone say, I'd love to invest, but I just don't have time to learn all that stuff? What if I told you that the best traders actually keep things ridiculously simple? So what do we do to keep from overcomplicating? And this gets us to myth number 3: is investing is just too complicated.
Yeah, that's a great question. And I've been working with someone who is very busy. They have a young child, and they want to play all the time. They're not in school yet, right? So under 5, and there's not a lot of time. And I always talk, when I get that situation that comes to me, I always go back to Darvis and his book, How I Made My $2 million.
Yeah,
can't get the book name there. How I Made $2 million in the stock market.
That's it.
By Nicholas Darvis. So that was one of the first books that I read. And so maybe that's also why I was inclined. I was like the second book I read after How to Make Money in Stocks. And, he was a dancer by day and a trader by evening. And so, he was never looking at the live ticker. He didn't know what was going on. And he wasn't even looking at charts, right? He was like a mental chartist, which is just amazing to me. So anyway, like this mom that I was talking to is very busy. I'm like, all you need are weekly charts. Because the thing is, the day-to-day, I see so many people freak out about the day-to-day. And I'm like, well, what does the weekly chart look like? And it looks fine.
Yeah.
So I think if, you have some time on the weekend and maybe just a little bit of time during the week, and you trade by weekly charts and you make that your time frame, I think most people can find the time to get it done, for sure.
Right on. So, see, Mike, we got a couple other questions in there. Go ahead and jump on those, if you would.
All right. So let's see. So what's one thing you wish new traders understood about keeping their trading simple?
Oh, what's one thing I wish they knew that would keep it simple? We've already talked about so many things. I think you just going back to, you only, like for the market health, market health. So is the market healthy, red light, green light, yellow light. And I think if they could just understand that you only need to look at those 2 moving averages and where the stock closes and races in the 21 EMA. And actually, I'll give another shout out to Mike Webster, because he uses the 21 EMA a lot, and sometimes he likes to even keep it even simpler. He'll just say, well, as long as we're above the 21 EMA. There's so many things you can look at, but you don't really need to look at that much to just give you the health of the market. Because if you put too many things in your head, right, you get confused potentially.
Yeah, right on.
And then you don't want to take action. Same thing with the weekly charts, right? The weekly charts, you can use just simply the 10-week moving average and the 40-week moving average. I mean, and that was the whole premise in our book. We did a study, and we created the 40-week moving average rule, which was my rule. I was the one that was like, no, we have to test the 40-week moving average, and which we did find had the biggest gains. However, the biggest drawdowns as well. But if you pair that with, you always have a certain amount of gains you want to retain, then it can be manageable. And again, it doesn't have to be really complicated. I guess that's what I would say. It's just really, you can look at as many indicators as you want, but there's really only a couple that you need to just ensure you're going in the right direction.
Excellent. So without giving away what's in the book, please don't, but from the simplicity of utilizing the 40-week, because I love the 40-week. I like to look at the monthly, a day or two before the end of the month and after the month begins, the weekly, and then the daily. Now, occasionally I'll switch over to the intraday, but on the 40-week, which is a moving average that I do use, along with the 8-week moving average, which I love because it corresponds with the 34 or 50 day moving average. Could you walk somebody? Are the simple triggers? You're watching a stock, and are you buying on a pullback to the 40-week moving average, or a breakout above the 40-day moving average? And then the simplicity of what's your initial sell rule on it?
Well, that's a great question. And I think we were talking, I don't know if this was when we were already online or this is before the pre-show. But that's one of the things I'm studying more in detail is the 40-week line, and when is it really a sell? I mean, the rule is if it breaks the 40-week moving average and by more than 1% on a Friday, you sell it. I think I've got that almost exactly right from the book. There might be one other qualifier, but just to keep it simple. And then my personal rules, I look and see if that's happening, but then I also see where I am as far as retention of gains. And if I'm at maybe a 60 retention of gains, I might give it more room. It's more like an and, like it has to be this and this versus or.
Okay.
But I do have, and again, I'm always looking at charts, right? And I see these amazing runs, and I'll see one of the things Bill O'Neill used to teach was, the first touch of the 10-week moving average is okay. You can buy that first bounce and maybe the second, but then after that, it's probably going to build another base. And so you may want to take gains or hold through that base depending on how much profit you have or cushion, how much cushion you have, profit cushion. So I have also noticed that most stocks will touch the 40-week line once and bounce. And again, these have to be the strong stocks, not just any stock, right?
Right.
And maybe even bounce a second time, and then maybe the third, it's going to start consolidating, right? So I will sometimes buy that bounce off the 40-week line, Dennis, because it's that first touch. It's a strong stock. Maybe I have a cushion, or maybe I'm not in it, but I want to get in it, and that's a good place to be in it. And when a stock has a big, long downtrend and has been below the 40-week moving average line, it's great when you can see a first stage base be created either right above that 40-week moving average or right below it. So definitely it's a line, I think, to keep an eye on, especially someone like me or anyone out there who's listening who wants to work on their long-term holding strategy.
I love that. That's fantastic. And so
prices coming in to test the 40-week line, and you're buying that bounce off of the 40-week line. Where would you exit it if it continues to fall?
Oh, well, I think you would simply just use that bar, right? That bounce, if it cut that low and then went back below the line, I think you're just, you're out right away. And that's a great question, Mike, because I think, it's important to understand that if your setup that you're buying doesn't work, you sell it right away, right? I mean, we have this 7 to 8% stop loss that Bill O'Neill created from all the standard cup with handle, flat base patterns. And then when you're trying something unique like that, then you have to cut it even shorter. You can't really give it as much room because right away, well, it was supposed to bounce. It's not bouncing, so therefore it's negated.
It turns out to be a bad signal.
Yeah, exactly.
So one of the mistakes I see a lot of traders make, before we get into myth number four, with the complexity issue, one of the mistakes I see a lot of traders make is, okay, let's say that they've been struggling on utilizing stop losses, right? Whether it be a 5% stop loss, a 7 or 8% stop loss. And they get into a trade, as you said, based on a good trigger, good setup and trigger, and then it goes against them. And it's almost like they declare that stock has a plague. I'll never trade that stock again, which is one of the dumbest, stupid ass decision to make, because oftentimes you'll get a new setup and that'll go take off and be one of your biggest winners. So what would you say to encourage people to say, guess what? You can always buy it back. Or maybe that's what you say.
Yeah, I mean, that was hard for me, but what I like to remind people is the research, again, that I remember learning from William O'Neill is that, he would buy back stocks all the time, and he would say, buy it back plus a little bit more, to help you if you're wrong, right? And sometimes, it's nice to see a shakeout. So depending on how it took you out, if it was a shakeout, you can be like, oh, well, it took me out. It shook me out. But look at this. You can see the shakeout where it's closing at the top of the range and maybe there's volume with it. And then you've got that indicator to be like, okay, well, this second attempt may potentially work. And the other thing I like to remind people, especially if it breaks out and comes back to the buy point, I mean, about 50% of the stocks always come back to their buy point. So that's the other thing I think that people need to remember. It's like, oh yeah, well, it's just coming back to the buy point. So for people that didn't get into it, they get a second chance. And then for the people that are already in it, they just have to remember, oh, well, maybe I'll just add a little bit more if it then comes back through. I mean, and then that helps your mindset turn it into a positive versus thinking of it as a negative.
Right on.
And I guess that's why Bill was always buying a little bit more, because then that made it more of a positive. Because, he shook out, but he bought it back. But he's making it more of a positive by adding just a little bit more.
Yeah. And I can't remember what stock it was, but one of my favorite Bill O'Neill stories was about where he was shaken out of a position 3 times.
Oh my God. Okay.
He bought it back all 3 times. And the last time he bought it back, it went on to be one of his biggest winners of the year. Do you
remember what stock it was?
No, I can't remember. Okay.
Okay. You find out and let us know. I don't remember that story.
And I love that story about, he talks about that. Yeah. And so Mike, let's go ahead and into myth number 4.
Yeah. Myth number 4, you have to have a finance degree to be a great trader. So yeah, some people seem to think that if they don't have a finance degree, they're doomed to fail. But the truth is that most successful traders started with no experience in finance. I think all 3 of us started with no experience in finance. So yeah, as somebody that didn't come from a financial background, you started as an engineer. How did you go from that to being trading now, and what skills from your engineering background actually helped you in trading? And one more question because those aren't enough. I'm personally curious to hear about what other skills do you think that would be helpful for new traders that perhaps we haven't discussed yet.
And then one more question to add on to what Mike said, okay, because we're trying to jam this on, is what new skills are you currently working on to refine? But start with Mike's first question. He may have to repeat them.
Okay, well, I think I might remember some of them. Okay, well, one example I always like to bring up, and I haven't talked about it in a while, so it'll be good. People who haven't heard it can hear it, or people who never heard me talk will hear it. But when I was an engineer, one of the things that was very important, I worked at a chemical plant. So root cause failure analysis was a very important thing. And so what that is like if you have a compressor that, broke down, we're like trying to figure out why the compressor broke down. And we want to find out what the root cause of it was. Was it a pressure gauge? Was it lube oil levels? I'm getting really technical here, was it the motor? What was it, right? And what was the first thing? Because, if you failed, right, but was it all three at the same time? Was it just the motor? Because you want to fix the initial root cause of the problem, right? Because then if you fix that, then nothing else will happen. And I've worked with a lot of people where, they made all these mistakes and they thought they had to fix all these things. Yeah. And I just wanted to figure out, well, what was the first thing you did wrong? And it was like, oh, well, I sold because of this break below the 10-day or something silly like that. And then, they made all these other mistakes along the way. I'm like, oh, well, the only thing you need to fix is actually that problem where you just sold because of that small little shakeout on the 10-day moving average, which, and I think it was the 10-day. I can't remember the example exactly, but it was something very minor like that. It was like almost just a blip, but then they ended up like trading it all the way through. And so anyway, so my point being that you might not really have that many things wrong with you. You just have to fix that one thing. So definitely, I would say that learning that early on in my career has helped me with my trading, because I want to make sure, like, what's the first mistake that I made? And that's the other reason why I became a long-term trader, I think, because one of my first post-analysis reviews that I did of why I traded this stock incorrectly was that I was buying and selling it because I was getting scared all the time, getting shaken out with every single move. And when I realized if I had just bought it at that, quote unquote, first stage base and held it, I would have had like a 76% gain instead of like ending up with a loss because I bought and sold it the whole way through. So then I would say for a brand new trader, I think one of the most important things they can do, and I have to remind the people that I work with this a lot, is take a screenshot of the stock when you buy it and put it in a PowerPoint, the weekly chart, the daily chart, the monthly chart, and make a note where you bought it and why. And then when you sell it, do the same thing, because the only way to improve, in my opinion, is to look at what you did. Did it work? And if it did work, why? Okay, these are the things I want to keep doing. And if it didn't work, okay, these are things I don't want to keep doing. And what was the first thing that I did that was wrong that I need to make sure I nip in the bud? So those two things. And then there might have been another question, but I want to say one more thing. I think it's related, but also actually taking the time to create a trading plan. When am I going to look at my stocks? When am I going to, what am I going to do during the day? What am I doing in the morning? What am I doing in the evening? Or am I just doing it in the evening? Am I just doing it on Saturday? And make sure you stick to that schedule and make the schedule something you actually want to follow. Don't do it when, you want to watch TV, plan your schedule, plan where you're going to watch TV. And then when you're done watching TV, plan where you're going to look at your investing and, stick to that plan. And in addition to that, a plan for earnings season. Are you going to hold into earnings? Are you going to sell half into earnings? Are you going to sell all and buy it back? Always having a risk management plan. Every action you take is a risk management plan. So when you buy it, know when you're going to sell it and before you even buy it, right? Already know
Right
I'm
on.
going to sell it at 7%. Or if I'm buying a bounce off of a line and that setup doesn't work, I know I'm going to sell it. And that's going to take time to create all that. But having some type of investing plan to start filling in and making a living document, I think will go a long way to help new and traders and understand what they're doing and why, and continue to improve their skills.
Right on. So, let's see, the other question that was, we covered that. Background. To succeed, skills from your engineering background actually helped in trading. And I love the story about the pump. No, I don't know if it was the pump or whatever was the deal. Because
The compressor.
yeah, the compressor. Because I think that something about our the where our minds are situated as engineers. We're process oriented.
Mm-hmm.
And so it's always about the process. And I love what James Clear talks about. So many people focus on results.
Mm-hmm.
And I think that's where new traders oftentimes, they're so focused on the results that they think they're going to get. So their expectations are really high. And it kind of blows them away when in reality, their expectations, they get stuck on what's called Mount Stupid. And, and you may be wondering, well, what is Mount Stupid? And I'm going to show you that. I'm going to show you what Mount Stupid is really quick right here. If you've seen this is the Dunning-Kruger effect. And when we get started trading, we start over here not knowing nothing. And we're so excited and our confidence raises all the way up here, but our wisdom is still back at zero. And so we reach what they call the peak of Mount Stupid. And then we start learning and we start rolling over until we hit, oh my gosh. And it's on this rolling over part. So when so many people quit, unless they've got a great mentor or they're reading some good book, and they get to the valley of despair, and they've been working really hard, but the valley of despair is the only place they're looking up and saying it was so much easier before I started down this endeavor of learning how to trade. And so they tend to go back this way. And those are the people who are in constant search of the Holy Grail. But the people who I think you said persevere, and I love that, they're the ones that push up the other side, hit the slope of enlightenment until they hit the place of the plateau of sustainability. And I think all three of us have achieved that. I won't say that we're gurus or anything like that, but we know what works and what doesn't work, and we try to keep that as applied. If you've never seen this chart, I think it's really cool, and hopefully I haven't offended anybody, because oftentimes I see people stuck on Mount Stupid or in the valley of despair, and it's like a constant do loop for them as they're trying to learn how to trade. And that was for free.
That's interesting. Yeah, I've never seen that before.
So, gosh. So, Kathy, do you have any questions for Mike and I?
Oh my goodness. Well, I guess what would you two say to a brand new person starting out? I'll flip the question you asked me and ask you guys.
Go ahead, Mike. Start.
Yeah, thanks, Dennis. So
I have an answer, but I knew you were thinking. Go ahead.
I think that one of the most important things that people could do to jumpstart their learning in trading is to get around other people that are already doing what they want to be doing, that have walked the path. Because if you're trying to do this stuff on your own, it's exceptionally difficult, and that was true even after I read How to Make Money in Stocks, because when I read it the first time, light bulb went off. This makes a lot of sense. I'm trying to do it on my own, and I failed miserably. But when I found the New York City IBD meetup and I found other people that were actually doing it, then things started to click. And Kathy, to your point about it being like a university, that's the exact feeling that I had when I was stepped into the IBD meetup. I actually remember saying this is like, wow, this is like a grad school class, because I was in grad school at the time, and the levels of presentations and the discussion and the focus, that's what dramatically helps. So I tell people to not just study the books, but to get around other people that are doing the work, and you could help one another in a cohorted way.
Yeah, that's great. That's great. Yeah, I agree. And then we have so many great virtual meetups, and of course you guys, your podcast and all the YouTube videos out there. There's so much great learning.
Yeah, right on. So, and I'm a little bit more cold-blooded than Mike is, in that. No, because I get people that come up to me, oftentimes they know what I do for a living. They and they either see me on YouTube, they see me, various places. They catch some of the free education stuff that I put out. But they come to me and say, "Oh, I want to learn how to trade. Oh, it looks so great. It looks so fun, blah, 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 blah." And so what I get them to do is I say, well, the first thing you got to do is you have to buy my book. Now that, Trade Your Way to Freedom, or, it used to be, get, How to Make Money Trading Stocks with Bill and Neil. I'll suggest both of them. And I said, read these books, and then after you, and after you've read them, come back and we can talk about you becoming a trader, because by that time you'll have the ability to ask smart questions. The people who come back, then I encourage to get involved, and they have to qualify to be in one of my mentoring programs. And one of the qualifications is you got to read my book, or Bill and Neil's book, one of those two. But if you want to learn my system, you need to learn my book. And the people who don't read it and don't come back, that's okay. I mean, and it's okay. But it basically it eliminates the looky-loos. Then I can work with somebody who is at least taking some serious steps to become a good trader. They're not looking at the results, and they're also, I ask them, are you coachable? Can you learn? And if the answer is no, or if they demonstrate the answer is no, then my time is limited, and I want to work with people who want to learn and will demonstrate the ability to learn. So, but now I also recommend Mike's book also for him to read Mike's book.
Yeah.
Because it's brilliant. And I'm recommending your book now, Kathy. So it's one of those things. It's just, get people to sit down and study it. And if they lack the discipline and to actually just sit down and read a book, or even get the audio of it and listen to it, if they lack the discipline to do that, guess what? They're going to lack the discipline. Can they learn the discipline? Yes, they can. But they're going to initially lack the discipline to make it as a trader. And they'll wind up as one of those holy grail of trading chasers. And they fail to recognize that the holy grail of trading is found from within by what we become.
Yeah, that's great. I've done similar. Like, I tell them to read the book, and then they come back to me. And I haven't had a lot of people come back to me. So
it's okay.
It's totally okay. But then you find out right away, like, okay, well, if you really want to, you need to read this book first. And then if it clicks, let's go, and if it doesn't, well, that's okay too.
Yeah. Because golly gee, it's going to take for somebody to become, and if we were going to basically, let's burst some bubbles here really quickly before it is, a lot of people will come in, new people come in, and they will think, okay, I'm going to spend 2 weeks or 3 weeks or 4 weeks and know this trading stuff without a doubt. Each of you have mentioned that learning how to trade is much like getting an advanced degree, a master's or even a PhD. And I agree with that wholeheartedly. And each one of us have the scars to prove it, that's what we've done. But when someone, well, basically, let's burst the bubble. I think a lot of times a person should be willing to, I want to say, paper trade for 6 months to a year to learn the process. Now, some people don't agree with that. They think, well, no, you got to be trading real money, because if you don't trade real money, you're not going to have the hyper emotional tie and all that kind of stuff. And I kind of say, BS to that, simply because look at the great golfers in the world. Look at the great athletes. How much time do they spend practicing? Like probably 80% or 90% of the time. How much time do they spend performing? 10%. So it's the same way I think it is with trading, is that recognize that I'm going to have to do a lot of practice. And even Mark Douglas and his wife said, you need to have 400 trades under your belt before you really know your system. Mm. So how long is it going to take to get 400 trades? Okay. Anyway, that's enough about that. Any other questions for us, Kathy? And I promise the other answers won't be so verbose.
Yeah. Oh, no, I'm good. Thank you so much. I really appreciate being here, and it was a fun conversation. Thanks for your great questions. This is the first time I've done a podcast where we talked about these mindset things and these myths and false beliefs. And I think it's important to, make sure people understand that, trading is so much more than just the chart.
It certainly is. So, hey guys, just a quick recap. We've covered 4 myths and the key takeaways about those myths. And I want to continue to mention Kathy's book, The Lifecycle Trade, where people can find more. Basically, you'll find more about Kathy. We put the link in there. The link will be in the description also on the YouTube channel. And so I'd like you to, basically make some comments about your biggest trading mistakes. You can put those over, which will help Mike and I basically pull together future podcasts. And we still have an invite out for Mike Webster. We would love to get Webby on here chatting about all his stuff, because he's got so much experience. And so, Kathy, if you have any influence with Mike, please just twist his arm and tell him he needs to talk to Mike and Dennis. And I'm going to reach out to Kurt, Eric, and Eve and see if they might be interested in jumping on board. And definitely. So S. Jordan, you're very welcome. I hope you continue to enjoy it. And again, open up some good dialogue with us and chat about it. So that's it for today. Mike, you got anything else to say?
No, that's it, Kathy. This has been very, very eye-opening, and I'm thrilled that you were able to join us today.
Yeah, thank you so much. I really appreciate it, and hopefully we'll meet in person one day soon somewhere.
I hope so. Kathy, without a doubt, it's an absolute pleasure having you on board. And so with that, we like to say aloha and God bless everybody.
Hey, thank you.
Hang on, Kathy.